Hey everybody, it's Jordan here with eXp Realty, and today we're talking about the pros and cons of buying a home when interest rates are high. So let's check it out. Buying a home when interest rates are high means you'll pay more for your mortgage. You can't control what market conditions will be like when you're finally ready to become a homeowner, but higher interest rates don't need to stop you from buying. In fact, there can be advantages to purchasing a home at those times. The interest rate on your mortgage represents how much it costs per year to borrow the money for your home loan and is expressed as a percentage rate. It doesn't include the fees you pay to get the loan. The rate you're offered is based in part on information like your credit score and down payment, but it's also tied to market conditions. The Central Bank of the United States, known as the Federal Reserve, sets monetary policy depending on the strength of the economy. While the Fed doesn't dictate the interest rates charged by lenders, it influences them through the target federal funds rate. If the market needs a boost, the Fed can lower its target rate and make borrowing money easier. But if inflation is too high, the Fed can increase the target federal funds rate to rein in borrowing. Fluctuations in the federal funds rate don't directly affect mortgage rates, but they influence other factors that do, like the cost of conducting business for banks. Buying a home when interest rates are high. Buying a home when interest rates are high come with some obvious downsides, such as higher monthly payments. Your monthly mortgage payment is mostly determined by the loan principal, which is the amount you borrowed, and your interest rate. A higher rate means paying more for your mortgage each month and overall, which affects how much you have left over for other expenses and goals. You also may not be approved to borrow as much money at a higher rate. To approve your home loan, the lender needs to verify that you have enough income and assets to keep up with your payments. If your interest rate is higher, the loan amount you can qualify for is smaller, and you might not be able to afford properties in the price range you're targeting. Even the smallest shift in rates can challenge one's buying power. You could get priced out of the market. Many people feel their home buying dreams slip out of reach when it becomes more expensive to borrow. Though homeownership could have been attainable with lower mortgage rates, some simply can't afford higher monthly payments when interest rates rise. Here are a few benefits of buying a home when interest rates are high. Higher interest rates could be a blessing in disguise for prepared homebuyers. Here are some advantages of buying when interest rates are high. When interest rates are high, getting a mortgage becomes more expensive. The rise in interest rates has encouraged many buyers, particularly those with an existing property, at a better rate to pause their search. As a result, there is far less competition in the market than there was when interest rates were considerably lower. When supply exceeds demand, the market favors the buyers. The shift towards a buyer's market gives homebuyers more ammunition to negotiate with sellers who may need to lower their asking price. While home prices historically have appreciated over time, periods of higher interest rates can mean a price drop. Less risk for buyers. To protect the buyer, certain contingencies can be added to the purchase agreement. These contingencies must be met for the sale to go through. For example, a common one is home inspection contingency. If the home inspection reveals major issues with the home, the buyer can negotiate with the seller about completing the repairs before closing or covering the costs, or back out of the deal without consequences. Sellers usually prefer offers that come with fewer or no contingencies in a seller's market. Buyers may waive contingencies to compete with other offers. However, this puts buyers at risk of inheriting expensive issues with the home or losing earnest money if they end up backing out. The good news is that when interest rates are high and there's less competition for homes, buyers have more leverage to include the contingencies they need to protect themselves financially and feel comfortable with their offer. So what are some risks of trying to time the mortgage market? Well, with interest rates reaching historic lows during the COVID-19 pandemic, you may feel tempted to hold off on buying a home until rates drop again. However, there's no guarantee that this will happen on your timeline. After all, interest rates have been much higher, In fact, in 1981, for example, rates hit 16.63%. The 3% rates during the pandemic were quite an anomaly. With the high cost of rent, no guarantee of locked-in rate, and the fact that rent is essentially 100% interest, I would encourage people to buy if they can and start building equity rather than covering someone else's loan costs. Here are a few alternatives to traditional financing. In response to rate hikes, some lenders are marketing alternative financing options to help buyers lower their interest rate. However, these options could come with significant trade-offs, so it's really important to understand the risks and whether you'd be losing money in the long run. Adjustable rate mortgage. Compared with fixed rate mortgages, ARMs have a lower interest rate at first after a fixed introductory period, which can last 5, 7, or even 10 years. The rate will adjust from time to time and can change depending on market conditions. Getting an ARM means you'll start off with a comparably lower mortgage rate, and the fixed rate period gives you time to refinance your mortgage to better terms if you qualify. But you could face a higher mortgage rate once initial period ends, so you should be prepared to keep up with more expensive payments. A temporary buy-down. A temporary buy-down occurs when you pay an upfront cost at closing to get lower mortgage rate for the first year or two of your loan term. Although you'll earn a reduced rate initially, it could cost you more in the long term. Loans with a temporary buy-down can end up being more expensive than fixed-rate mortgages without a buy-down, so you'll want to crunch the numbers, check if you're actually saving money or not. A loan assumption. A loan assumption is when you take over the remaining balance on a seller's mortgage with their original terms, potentially giving you an interest rate below current market rate. With a loan assumption, you'll cover the difference between the sales price and the assumed loan's outstanding balance. That means options may be less feasible for people who don't have larger cash reserves, especially because it can be difficult to find a lender willing to offer a second mortgage to make up the difference. You want to ask your lender if loan assumption is an option and talk with the sellers about the terms of their outstanding mortgage. So, is now a good time to buy a house? Over the last several years, interest rates have gone from reaching historic lows to hitting the highest rates in almost 20 years, which means it's more expensive to buy a home now. But while higher interest rates mean higher costs, at least in the short term, you'll be able to start building your equity if you purchase sooner rather than later. In the long term, home values go up. The best time to buy a home was 20 years ago. The second best time is now. When will interest rate decrease? While many financial experts may offer forecasts, the truth is there's no certainty regarding when or how much interest rates will decrease. It is impossible to know when interest rates will decrease, especially given that the current rates are more in line with historic rates. If you found this video helpful, please hit the like and subscribe button for more great real estate content, and we'll see you on the next one.